Thank you everybody for joining. So this is the last roundtable in the series on reforming tax expenditures in Europe. Today we will be discussing about personal income taxes and wealth taxation. So very much looking forward to it. A few housekeeping rules first. So the event will be recorded and posted online on our website, cpweb.org. Remember that you are muted by default, so please just unmute yourself when the floor is given to you if you want to intervene. And if you want to make questions, particularly in the last part of the event, please use the raise hand option in the reactions tab that should appear in the menu at the bottom of your screen, or otherwise just physically wave, and I will try to catch that out. So let me give you a quick introduction on why, the rationale why we are setting this roundtable on reforming tax expenditure systems in Europe. So as you all know, tax expenditures are a valid policy instrument used widely to pursue different goals like attracting investment, creating employment, greening the economy, tackling inequality. Yet, very often they are costly in terms of revenue forgone. They are opaque, and based on the limited available information, they also are usually ineffective in reaching their stated goals and can also trigger undesired negative effects or externalities. Let me develop a bit further these 4 points that I think are crucial. When it comes to the fiscal cost, a significant amount of government funding worldwide is channeled indeed through the tax system as tax subsidies, tax reliefs, tax breaks, or what we call tax expenditures. On average, to give you a concrete figure, tax expenditure over GDP is 4.5% and can be as high in Europe, among member states, right? And can be as high as 13% in the Netherlands, more than 12% in Finland, and more than 10% in Czechia. So despite this significant fiscal impact, and the fact that indeed the fiscal effect on budgets is the same or very similar to direct spending, new tax expenditures are being introduced regularly without adequate scrutiny. And moreover, transparency on existing tax expenditures is often limited. Again, a few concrete examples. 3 EU member states, Cyprus, Luxembourg, and Malta, do not report at all the revenue forgone through tax expenditures. And at least 5 other member states, Czechia, Hungary, Portugal, Romania, and Slovenia, only provide very limited information. In any case, these 8 countries are breaching the Council Directive of 2011, calling for, and I'm quoting here, member states shall publish detailed information on the impact of tax expenditures on revenues. So this is not the case for at least these 8 countries. Besides a few worth mentioning initiatives, basically by the OECD, also cross-country comparable data is almost inexistent. So together with colleagues from the German Development Institute, we are launching in a few months what we call the Global Tax Expenditure Database, which is an ambitious project trying to fill in this gap. So stay tuned on that. But the cross-country comparable data is absent in the tax expenditure field. So as a result, tax expenditure provisions are hardly ever subject to sound analysis and debate. There is a lack of attention and evaluation, again, particularly when compared to direct spending entitlements. And this is alarming because, as I said before, often these provisions are ineffective or could trigger negative social and environmental side effects. So this is why we think that the reform of tax expenditures is vital. This is true in general, we think, but particularly now, while governments are facing the impact of the COVID-19 pandemic, and hence the lack of resources is even more marked. So with this in mind, today's roundtable will focus on tax expenditures implemented or channeled through personal income taxes and wealth taxes. And we will start today with Åsa Gunnarsson, who's professor in tax law with the Umeå University. So Åsa, you have recently led an ambitious project aiming to provide recommendations for fair and sustainable taxation and social policy reforms in the EU. So can you please give us an overview of the project and provide some insights on the role of tax expenditures in the recommendations that you managed to push through the project. Please, Åsa.
Yes, thank you for the invitation, and I will try to do my best and try to merge the idea about the tax expenditure reform with the results from our project. So I'm going to share the screen, and I start bildspelet. Start. So you see you see my screen now, or?
No, not yet. There's a green arrow at the bottom, share screen.
Yes, share the screen. You see my screen now?
No, probably you have to select what you want to share.
Okay, sorry. Now.
Yeah, now it works, right?
Yes, exactly. I didn't see that little thing. We start from the beginning. So here's the first screen. This is to show the call on which we based our project, and the most important part of the way we designed the project was to respond to the concern about what had happened with the national tax systems, and based on the need of moving beyond the financial crisis and the Eurozone crisis. So it was a crisis consciousness from the European Commission, which is similar to the pandemic situation we have today. So now, but without the crisis, I don't think that the call for papers or projects had been so radical from the Commission. What we did was to kind of talk about sustainability from 5 dimensions, which were, I mean, the European Commission had already defined social, economic, environmental, and institutional dimensions on sustainability, but we added also equality. And from that 5 dimensions of sustainability, we found a lot of sustainability gaps that had to do with how the tax system in Europe on national level were designed, but also a lack of initiatives on the European Union level. As you can see, we talked about the lack of progressivity, from capital and wealth related taxes. We saw that there was a high burden on taxes on earned income, on labor income. We also saw that there was a decrease of using Pigouvian taxation for particularly environmental objectives. And we also saw it was a lack on the European Union level when it comes to, of initiative concerning environmental issues and taxation. So this is a long list of and we also saw the lack of equality and tax fairness on many levels in the tax system. And finally, as I'm a tax law professor, we did a working package on the lack of legal competencies. The project was cross-disciplinary. So we worked economists, fiscal sociologists, lawyers, and that was I think it was very productive. because we had to really discuss the dimensions of sustainability, tax sustainability. The strategy of finding a smart, sustainable, and inclusive growth path in Europe, it's a lot of words, nice words. The results in the project show that the social dimension of taxation is neglected in research as well as policies. We saw there was a basic problem around tax fairness. Also saw the lack of both effective legal and policy mechanisms. And the one-sided tax for growth paradigm that have been around now since the beginning of the 1990s, we could, as many economists and others have showed, see quite a big correlation between income, the increase of income inequalities and this kind of dominant taxing for growth, economic growth, and expanding the kind of internal market in the European Union. To turn these results to the perspective of tax expenditures and the need of a tax expenditures reform, is that I would say the headline of this slide is like a kind of a result or a kind of a conclusion of all these years of research, that it seems like the benchmark used that has been used on the member state level as well as the Commission level for pre-crisis at least, is that redistribution is regarded as a tax expenditures, tax provisions that promote redistribution and some type of tax fairness are regarded as tax expenditures. And that is when you work with, if you work with the tax expenditure literature and the concept, one see that the whole point, the whole idea is to kind of target tax measures that deviates from a benchmark, but the benchmark is highly normative and differs between jurisdictions. What has been in our research, we could clearly see that tax expenditures that deviates from optimal tax theory thinking and efficiency and the principles of neutrality and uniformity were regarded in many countries and on the European level as well as tax expenditure. The benchmark, the benchmarking was that non-progressivity was preferable, and flat regimes were most preferable. Low taxes on corporate and capital should be low. And this is kind of, when it comes to corporate, it was of course the competition between countries, which the European Union hasn't solved, that we have a competition between internal corporate competition between the European Union jurisdictions, and that it seems like also the benchmarking have been captured under a very strong voice, or like this is grandfathering, that we should protect and promote capital, also based on as it is mobile, it's based on the mobility of capital as well. And you should have uniformity regarding rates on consumption. You should have broad tax bases, and social justice objectives should be not a part of the income tax system. It would be kind of a task for the transfer system. The case of capital income tax is it's very obvious there. Most of the European member states have dualized the taxation of earned income or labor income and capital income. And Sweden is one of the Nordic dual income tax model that is stronger, that are launched most strongly in Sweden has become a work of fiscal termites, if I use the Vito Tansi's concept. Abandoning the global income tax scheme and separating capital from earned income have created immediately a huge tax wedge gap, and has continued to erode a different and differentiated capital and income taxation. And we have several rates, and we have also elaborate with a tax base. So it's become a kind of a race to the bottom syndrome, and a lot of statistics has shown that the capital income has increased greatly in Sweden, and has incentivized income shifting from high tax to low tax capital income. So that has been obvious. So this the basic neutrality and uniformity benchmarking has now kind of turned around against itself, and the tax expenditure problem is obvious. So a little bit about wealth and property taxation. It's not so much to say, because Europe has kind of abolished wealth taxation, and it seems also that the very deep cultural roots of property taxation, which has to do with different systems of ownership and how to own and so forth, that is so very different in the European jurisdictions, have created a jungle of tax expenditures, I would say, in every country. And from Sweden, which I know the best, is that we really tried to reform the wealth taxes in the 2000s, and we had two or three reports that kind of wanted to make the tax base much more broad and much more sustainable, and without all of those loopholes. And instead, it just became some kind of political negotiations, and one of those kind of strange things that happened was that the left party really helped to abolish the last wealth tax we had in Sweden. And the latest tax reform report that has been presented last year shows that it seems like we have a very regressive property tax system in Sweden, tax system in Sweden. So I think wealth taxation is kind of, if there are wealth taxes left in Europe, in the member states, they probably are full of tax expenditures, and the property taxation is also a big problem from a tax expenditure perspective. So this was my intervention on the question from you.
Thanks a lot, Åsa. Very interesting. A few things that we will be discussing throughout the event. We will come back to wealth taxes with Arun in a bit. So thanks a lot. So regarding the impact of tax expenditures on inequality, which is one of the core topics of the Fair Tax project, when it comes to those tax expenditures granted through personal income taxation, there has been a bit of research and studies on that area. Salvador will tell us in a bit the work that he and his team has been doing. But there are some other inequality dimensions that have been somehow overlooked. So Tom Newbeck, who is CP Senior Associate, has just finished the policy brief assessing the disparate racial impact of tax expenditures in the US, a topic that, again, has not been discussed as we think it should be. And likewise, there are, besides a few exceptions, there are a striking absence of perspectives of gender equality in tax policies and reforms, also in the context of tax expenditures. So Åsa, what's your view on the latter, on this gender equity impact? Do you observe any positive changes in this area lately, particularly when it comes to tax expenditures?
I would say that you see my slides again? No?
Yes, we do. You might want to put them in a presentation mode, but we,
okay.
Yeah, exactly.
So I have them in the same place. We wrote this report for the European Parliament's FEM committee, and this has been, no, there hasn't been so much about that has been done when it comes to gender equality and taxation. It seems like the sustainability gaps that we have talked about is very much working against the gender equality. And here we have, but here also when it comes to the perspective of gender equality and taxation, there are very interesting tax expenditure issues that are long and there are long stories and unsolved in many jurisdictions in Europe. I jumped this. This was just the recommendation. We did this in this report, but we did also micro simulations in some of the in 6 European countries, and we could this was Austria, Czechia, Denmark, Spain, Sweden, UK, and we tried to kind of make multiple scenarios, because if you look at the kind of benchmarking on taxation and the tax unit for personal income, the individual is the preferred option, but that's not the situation. It's just 2 countries in Europe that have a pure individual income tax system, and as far as I know, and that's based on interviews from Minister of Finance and so on, made by Professor Mulder in Belgium. But she could say that it's just 2 pure income taxes, individual income tax systems, and that is Finland and Sweden. We from the conclusion from the micro simulations in these 6 countries, where you have joint elements in most of them except for Sweden, you could say that flat tax increases income inequality, joint taxation decreases income inequality. Intra-household perspective, from an intra-household perspective, flat tax favors main earners, and joint taxation favors main earners. So you can see that is, you've probably seen those kind of opinions before, but we could just show you, we could show that it's clear, then still very clear what is needed when it comes to gender equality and taxation. And the European Commission and many of the member states knows about this, but it's a very deeply rooted, it's not an economic issue at all. It's a very cultural, religious issue, and where, like, the deep layers of ideology in a society seems to be to keep women close to the children. We also looked about social policies for family household with children, and we could say, and that is something that is very important to keep to remember when we are going to discuss when the effects of the COVID-19 should be discussed or are discussed, is that we have to, it's to give cash child benefits through directly to the household will improve the income equality or empower the family. So it's not that good to through joint taxation or to tax allowances based on the household income or so on, or tax credits based on the household income, transfer money to family with children. It's much better to send the money directly to the family over the benefit system. So that's a very typical example on a old traditional tax expenditure system, where the benchmark is pinpointed and it's up here, and a lot of countries do absolutely the opposite way. So that is a kind of an answer maybe on your question. So what we think about gender equality and taxation in the EU is that the member states' tax systems continue to feed and stimulate tax traps for secondary earners. And it's a big problem in many ways. And based on our research, and other sources, of course, also, the Parliament, European Parliament, made a resolution where they promoted that member states should introduce individual income taxation. So it's we have it. It's declared on so many places, but it seems to be a very strong bias to keep the system. So my concluding remarks on tax fairness challenges is like there is a very tax treatment of wealth, capital income, and top incomes are too generous. And there is a too high burden on low and middle income groups. And especially if we put it together with the social contributions and the VAT. And I would say that thanks to a lot of tax expenditures that are hidden, embedded in the tax systems, it seems like the last decades of tax reforms imply a shift of the tax burden away from the men towards women. And we think for the future, we need to concentrate on tax-based issues. Yes, okay. Thank you.
Thanks a lot, Åsa. And that's exactly what we're trying to do throughout this series. If you can stop sharing your screen so that we can move. Yes. Yeah, great. I know. Yeah, great. Okay, so let me then move to Salvador Barrios, who is team leader within the Fiscal Policy Analysis Team of the Joint Research Center of the European Commission. So the center has produced a lot of research assessing the fiscal cost, effectiveness, and distributive impact of several tax expenditures. Several tax expenditures granted through the personal income tax system. And Salvador, you have been leading part of this research. So can you please give us an overview of the work of the center in this field?
Yes, thanks, Agustin. Thanks for the invitation. It's a big pleasure. I appreciate, and I found the presentation by Åsa quite interesting as well. And there are many points that were of common findings compared to what we do here at the Joint Research Center. So just to give you an overview, here at the Joint Research Center, we support policy services in Brussels, developing models, and in this case, our focus has been on the personal income tax using the Euromod model, right? We have also other activities where we also look at other type of tax expenditure and the corporate tax area as well. So maybe a bit of explanation. I think it would be useful to explain how we came work on tax expenditure at the European Commission in general. I think it's important to remind that, I mean, this debate, at least at EU level, became prominent with the financial crisis and the need to have more transparent figures from the member state on in particular, the fiscal impact of tax expenditure. In general, tax expenditure, we know they are privileged by policymakers because it's an easy way to spend money, and it comes relatively unseen in the public budget. So that can be a way to favor certain group of the population, to promote certain social goals, but it triggers a lot of issues regarding fiscal policy. So in particular, tax expenditure introduces a lot of distortions, and they are prone to rent-seeking behavior. Now, tax expenditure are justified on the basis of social goals, right? They are not. They can often have this lack of transparency, negative aspects. But if they exist, is that because they are seen to be useful, so to promote employment, housing ownership, etc. Now the problem, and I think Åsa mentioned this, is that that's a way to avoid tax in many situations, especially for the wealthy strand of the population. So here at the JRC, our approach is by definition cross-country, right? Because we have working for the European Union, so that's by definition our task. There are many studies existing looking at country-specific issues with very good data. Our approach is quite different. So we lack of the information that you may avail when you have administrative data and that you can analyze when you have a very detailed on the tax expenditure schemes, especially for personal income tax. I mean, in some countries, you have very complex tax expenditure system, sometimes very exotic, if I may say, tax expenditure scheme. The nitty-gritty detail of each country, especially some countries, is very difficult to capture when you have this EU level approach. So in our case, we use for the personal income tax part Euromod, which is a microsimulation model, which has been transferred recently to the Joint Research Center. It was based previously at the University of Essex. And what Euromod or microsimulation model bring is a number of clear advantages, especially when it comes to analyze the redistributive and fiscal impact of tax expenditure. That's something which is relatively difficult to conduct with cross-country analysis, but the advantage of using a microsimulation model is that you account for the interaction with the rest of the tax and social benefit system. So now, in our case, we cover only broad categories of tax expenditure, and we use survey data. The self-reported information on tax expenditure in this case is very scant, right? It's better to have administrative data, or even better to complement administrative data with survey data, especially when you look at labor incentives related to tax expenditure. So some countries have very complex tax system, very complex tax expenditure system, which are nearly impossible to capture when you have this cross-country approach. Now, a lot can be uncovered when you carry out a cross-country analysis. For instance, a simple direct comparison of by broad category of tax expenditure, comparison of the modus operandi of tax expenditure. It can be tax rate reduction, tax allowance, reduction of the tax base, refundable tax credit, or deferred tax payment, for instance. Just the design, analyzing the differences across country in terms of the design of tax expenditure for the same declared goal of the tax expenditure is very telling and very instructive. Another aspect I mentioned is the interaction with the tax and social benefit system. That's one of the big advantages of using microsimulation model. In general, the member state, they report estimate on the impact of tax expenditure on the basis of the tax return data they have. Sometimes they perform microsimulation analysis or they simulate this impact. With microsimulation model, you simulate systematically. So that means that you can take into account interaction, in particular with means test benefit, right? Because tax expenditure provisions are often based on net income. So as I said, there is the kind of negative aspect, negative view on tax expenditure, but I think this is very much the legacy of what happened with the previous financial crisis. If we think, for instance, about the tax expenditure for housing ownership, right? In some countries, there were very, very generous tax expenditure schemes, and it has been well documented that those schemes were part of the problem when it came to amplify the impact of the housing bubble burst. But tax expenditure also have a positive aspect. They have at least declare social goals like promoting home ownership. This is widely used, but it can create problem, as we saw with the financial crisis, in terms of promoting housing bubble or favoring over-indebtedness by household. Then another category, important category of tax expenditure we have paid specific attention to is the make work pay tax expenditure. So in-work benefit, right, which can take the form of tax expenditure. Here, the idea is to really to provide an incentive, right? And the social goal is clear, is to promote labor supply and later employment. Now, analyzing tax expenditure like this, focusing on a specific country, may hide important differences and lessons learned from a cross-country analysis. In particular, one needs to consider the institutional setting of the tax expenditure in place, in that case, for make work pay. The existence of a minimum wage, for instance, the existence of means-tested benefit, institutional aspect of the labor market setting, wage bargaining, employment regulation, or the existing labor demand. All these factors condition the impact of tax expenditure. In that case, if we consider make work pay tax expenditure, their impact will have a direct relationship with all these institutional features. And that's why comparing tax expenditure across countries allows one to highlight those differences aside from the difference in terms of design of tax expenditure. Another category of tax expenditure we have analyzed and we provide a regular assessment on is health and education tax expenditure. Here, the tax advantage is granted depending on level of expenses in terms of, for instance, private health services or private education. So in that case, the evidence from our analysis shows that there are potential significant redistributive effects of these schemes and potentially the risk of creating a dual health service system and a dual education system, which might strongly distort health and education outcome. Last but not least, but I think I can speak about this in the second part of this panel discussion, concerns the case of pension tax expenditure, which are often completely overlooked, especially in terms of debate regarding pension system. And those tax expenditure are especially complex, and they have potentially large and long-run effect on labor supply choices and savings. So they are very important, but often overlooked because of the lack of tools and information on this type of tax expenditure. So as Åsa was saying, tax expenditure requires the definition of a benchmark. And this is very important because in the end, you can have very different benchmark. I mean, it's not clear what is the correct norm, or benchmark? How you will define it? Sounds like a theoretical question, but in fact, it hides very important issues. And here again, cross-country comparison with microsimulation model possibly can raise very relevant questions, which are not perceptible by policy makers when you consider specific country cases. For instance, personal income tax allowance or deduction of social security contribution can be considered as tax expenditure. And in some cases, but in other, they can not be considered as tax expenditure, depending on the norm in the country, which links very often to cultural differences. In fact, nearly all benchmark can be justified. It really depends on the institutional setting, the social norm, and the culture. But in the end, these benchmarks reflect social choices, which have significant redistributive and fiscal implication. I mentioned before the case of housing tax expenditure. This takes the form often of mortgage tax deduction, right? So that's considered as a normal thing in many countries, and it's largely used in the EU. But in many instances, some questions are not really asked. I mean, why should we subsidize home ownership versus renting? I mean, renting can prove more efficient regarding labor market mobility, for instance. But renting, promoting the rent of house and dwelling, can cause also problem, especially for the elderly, for instance, depending on the pension level. So a more neutral tax system vis-a-vis housing, so less distortive housing tax expenditure, might be more justified if, for instance, there is sufficient share of subsidized housing or decent or high enough pension income. And that's not the case in all countries, okay? So just to give you an example of how the benchmarking exercise one conducts when looking at cross-country issues, it can be revealing of those questions which deal with the very impact of tax expenditure, their social justification, and in the end, their efficiency. And the efficiency rests very much, and here I agree again with the previous presentation, the social aspect links very closely with the redistributive impact of the tax expenditure. Because they are not well captured, because the information is not provided similarly across countries. Some countries have a long tradition of providing information on tax expenditure. And in those countries, it's easier to make a judgment on the redistributive impact. But in many countries, this information is not available. So tax expenditure can have big impact, a big redistributive impact, but they can go completely unseen in the public debate. And the argument, often the argument used in the policy debate comes with a lot of distortion. Let's say it's very easy to be cherry picking and blame a specific tax expenditure, while other tax expenditure can have huge impact and be very distortive. I referred previously to mortgage deduction, mortgage interest rate deduction, which in many countries are clearly in favor of the middle high classes. Those things can go completely unseen in the public debate. So I think the use, just to conclude, the use of microsimulation model, more studies making use of this model, possibly with better data, and the future effort should go toward using more and having more access to administrative data, is something that is much needed to provide more transparency to the tax system, especially in terms of its redistributive impact. That's about it for me at this stage. Okay. Thanks.
Thanks a lot, Salvador. Very interesting. And you mentioned a few times that indeed tax measures can have worse supporting goals And that's very often the case. What is tricky for me is how to be sure that those policies are the best way to get there, because we all agree that boosting R&D and innovation is a world supporting goal. What I'm a bit more suspicious about is whether implementing patent boxes is the way to go. And this type of questions is where I think there is still a gap to be filled, and where I find the work that you do interesting, in the sense that you move into the evaluation of these provisions. And in that context, I find particularly interesting the work that you do on pension-related expenditures. I mean, for a bunch of reasons. I obviously, the sustainability of pension systems is crucial. It's a hot topic nowadays and very likely increasing in terms of relevance worldwide. But also, very often, pension-related tax benefits are granted as deductions, right? And deductions, we know that are within the family of tax expenditures among the regressive ones, because the benefit increases with income and with the marginal tax rate. So I was a bit surprised when I found the results of your paper, actually, because you have a very positive finding there. And I'm quoting here: tax expenditures tend to be progressive on two levels, among pensioners by favoring those with lower incomes, and among people of working age, because of partial or no deduction for pension contributions. And the other aspect I wanted to flag before giving you the floor to develop a bit on that piece of research is the fact that by granting a tax benefit, you are mechanically living outside of the potential benefit the informal workers and the low-income earners that have income below tax-free thresholds, right? So with all that in context, can you explain how you get to that positive result in that piece of research?
Okay, so let's discuss about our results directly. So, I mean, just as a matter of introduction, the pension tax expenditure are possibly the most complex category of tax expenditure. So, in that respect, I mean, I mentioned the use of microsimulation model. I mentioned the issues regarding data. Well, in the case of pension tax expenditure, this is maybe where it comes to be the most problematic, right? Because we, with Euromod, for instance, we use cross-section data. Pension is clearly a lifetime dimension. The information we have and we used in the paper you refer to is just cross-section, and we have very limited information on the working history and on the labor events of individuals, right? In particular, in terms of the time period they were active and working. So the exercise you refer to is it was a very novel exercise, right? It shouldn't come as a surprise because it's a very tricky, very difficult one. So we were, in a way, quite brave in doing that, but I think quite successful. I think to provide a quick reply, I think the result we get might prove surprising for you, depending on the perspective you take. And here, I think the definition of the benchmark is very important, right? On the one hand. The second hand, the level of public pension, okay? In particular, minimum pension is very important to take into account. So the benchmark is important because in this case, what we do is we look at the existing system in the member state, in particular, what is the fiscal treatment of the contribution, the accrual, and the benefit. Okay, well, the accrual, actually, we make simplifying hypothesis because in the end, we don't have information on that. But if you look at contribution and pension benefits, what dominates in Europe is an exemption system and a tax system. So what we call an EET system, right? So what we do is we take this as a benchmark with all the generalization this implies, because there is no pure, in fact, EET system, right? We just kind of a group country into these different categories. Because it's the dominant system, generally speaking, we take this as a benchmark. So all the results need to be interpreted against this benchmark. Okay. So against this benchmark, it makes sense to find that pension system tax expenditure, because in many countries you have an exemption of social security contribution or contribution to pension, then it's normal to find that the existing tax expenditure are relatively generous given the benchmark and favor relatively more low income worker and low income pensioner, because you have relatively generous public pension system, okay, in relative terms. Now, coming to pension, I mean, going a bit beyond the study, just to tell you also, we continue to work on this. We continue to work on the analysis of pension expenditure, and we have done, we are currently doing analysis following the same approach as in the paper you refer to, but using different benchmarks, right? We do that together with colleagues in Brussels, and that is something which is largely motivated by the analysis of the pension adequacy in the EU. So this analysis will go in the forthcoming pension adequacy report to be published, I think, sometimes late spring this year. And there you will see the result of our analysis using different benchmarks. Now, this is all very limited in terms of let's say, robustness of the result, because of the data, because of the simplifying assumption, because of the very limited information we have. Now, having said this, this type of analysis, given all these limitations, has strong value because it documents the redistributive impact of pension treatment. That's something which has never been done at the EU level. And pension tax expenditure, and I think we provide a lot of arguments in this line, should be considered, should be made more prominent in the debate on public pension and pension system in general, not only public pension. If you look at the policy discussion regarding the sustainability of pension system, it's generally focusing on the period of reference for the contribution, the level of pension benefit, etc. It's rarely dealing with pension tax expenditure, while those pension tax expenditure are present everywhere, but they go largely unseen. They are not considered in the analysis, and they are often not concerned by policy reform. And why is that? Because clearly there are clear political advantage in granting tax expenditure, favorable tax treatment to the pensioner, because it's something which goes like a hidden social support, which everybody agrees with a delayed economic costs, right? So it's a kind of win-win for policymakers, but not necessarily for the economy in general, and in particular for the sustainability of pension system, and therefore for the sustainability of public finance. So here again, the discussion on the benchmarking is not a semantic one. It really points at the diversity of systems and their very different redistributive impact. And that matters a lot when it comes to think about the redistributive impact, the well-being of not only the elderly, but the perspective for current worker. So here there's a lot to learn, a lot to do. Our work is really, I think it was the first one to be done. A lot of limitation. It's questionable in particular because the benchmark we choose is questionable, but any benchmark is questionable, right? And then much progress needs to be done in terms of data, in terms of model, So just to give you a flavor, we are currently trying to improve things at the GRC. We've been working for nearly 3 years now on developing an overlapping generation model, which is closely linked to the Euromond model in terms of its microeconomic structure. And what we do is to develop this OLG model to include country-specific pension system, including a detailed taxonomy of their tax treatment. So we do this precisely to overcome the limitation in terms of the type of conclusion and the, let's say, validity of analysis solely based on the Euromond model. But just to say that there is a lot to do also, just to as a matter of conclusion, there is a lot to do in this area. The limited attention paid to pension-related tax expenditure is in clear contrast with their relevance. Pension and tax expenditure are sizable, and they have a strong impact in terms of short-term budget, but also in terms of sustainability of public finance. And it's an area where policy reform can be done with quite a significant impact in the long run for the economy and for the public budget, but which, because there is little is known in this area, which has rarely been dealt with by policy analysts. That's something we try to work on.
Thanks a lot.
Thanks.
Thanks a lot. And I think that, again, the beauty of using this micro simulation model is the ability to compare countries, which is something that is only possible in terms of the benchmarking through this methodology. And coming back to the pension, this is a topic that, well, again, will very likely come back when we talk about wealth taxes, right? Because this is also part of the tax base of for wealth tax and the assets saved into pension funds. But before moving to the wealth tax discussion, let me introduce Barbara Bratta, who is senior economist with the Italian Ministry of Economy and Finance. And it's great to have someone that is really hands-on in terms of tax expenditure estimation or reporting. It's something that we have been missing in previous series or roundtable. So it's great to have you, Barbara. So Italy has indeed one of the most detailed tax expenditure reports, probably with the one from Canada, as far as I know, but certainly in the EU, one of the most comprehensive and detailed ones. So you provide not only revenue foregone estimates on a very high number or large number of tax expenditure provisions, but also a significant amount of metadata, including, for instance, the number of beneficiaries for certain provisions, which is very rare out there in tax expenditure reporting. So Barbara, can you please give us a bit of an overview of the process behind the estimation and reporting of tax expenditures in Italy?
Hi, everybody. First of all, thank you for inviting me. And it's indeed thank you, Agustin, for organizing this round talk, because they are very interesting. And as the one before me said, it's indeed on the topic. So I will not share the screen. So can you see that? Perfect.
Yeah, all good.
So essentially, as I said, this is indeed an important topic, and I can give, as you asked, I can give a bit of a perspective of the government, of Italian government in a sense, and can talk a bit about, as you said, the Italian tax expenditure report, because we are all aware that having a tax expenditure report is not everything that we need to do in order to reform tax expenditure, but it's indeed the first step that we should have, right? It's the first piece of the puzzle that we should, in a sense, do. We should compile the best as possible tax expenditure report, so that using that, we can then understand better what are the tax expenditure in our country, the overall costs, and then perform some ex post analysis that we've been performing over some of the tax expenditure. Of course, not on all tax expenditure, because there are many, but at least in some of them. So just to give an idea of how it looks like. So this is essentially, so when you look at the tax expenditure report in Italy, you would find essentially a series of tables that contains a lot of information about the tax expenditure. And I think it's useful to have an idea what kind of information are there. Of course, there is also written parts that explain and analyze them and see if they are overlapping and so on. But I think it's very interesting to understand what is inside those tables. So as you can see, if you look at the tax expenditure report in Italy, and that is available online, by the way, you can find that there is, of course, a first column that is the progressive number, so that you can easily count the number of tax expenditure reports. For 2020, we have 602 tax expenditure. Then you have the column that is the law by which it is being introduced, that specific tax expenditure. And I believe this is important to keep whenever a country has a tax expenditure report, because this is essential whenever the taxpayer or whoever, or a researcher or whoever is going to read the tax expenditure report and has some sort of additional guess, would like to have some additional information, then can look at the law that introduced a specific tax expenditure and go more in depth into the analysis, understanding better how the tax expenditure work. Then there is a short description, so to keep track within the report. And then we have a series of columns displaying the characteristic of each tax expenditure. As you mentioned, we have several characteristics that are reported within the tax expenditure report. So, for example, we are able to see if what is the tax base. So, for example, it's corporate income, personal income. What is the type of tax relief? So, is it tax credit, allowance, exemption, exclusion, and so on. If there is a sunset clause, then the tax expenditure report would point it out what is the year of the ending. And this is very important in the sense so that having a sunset clause enables at the same time both that the tax expenditure is short-lived in a sense as a time limit. At the same time, it's push toward more accountability, as then since it has to be renewed and there is more attention to that, and it's possible then to have a better, a more in-depth analysis on that specific tax expenditure. Then we have also type of beneficiary, it might be corporate, fiscal person, and so on. After that, we have a series of columns reporting the estimated financial effect. So we report 3 years after the year of tax expenditure report. So for example, the latest tax expenditure report, this is the 2020, we have the revenue foregone from 2021 to 2023. Then we have additional information, as you mentioned before. So for some of the tax expenditure for which we do have data, we have the number of users or the average per capita cost, or also some other information telling us, for example, if that specific tax expenditure was there for more than 5 years, which in principle might indicate that we should look into more detail because we will have enough data. Because the data gap is also the data gap is always to keep in mind, because we need a couple of years before the introduction of tax expenditure to have the data from the tax return information. And so some ex post analysis can be done only after a couple of years. So so this is some other important, I would say, important element that characterize our tax expenditure report. So as I said, it's publicly available, which I think it's very important, so that any taxpayer or any researcher can look at it and can see the data. And it has been prepared by a specific committee that is composed of 15 representatives of statistical, financial, subject is the Prime Minister Office, the Ministry of Economy and Finance, and professor. So the idea here is that our tax expenditure report is compiled every year by the most specialized expert in the area. So to provide the best job as possible, the highest quality report that we can have. So the report has been introduced by a law in 2015, and the law said that essentially we should do the report annually, in order to reduce, eliminate, and reform the tax expenditure that appear unjustified or overlapping with some other expenses of the objective. So as you can see, since the beginning of the story of our tax report, the aim was always that. The aim was to rationalize the tax expenditure and increase accountability. But in order to do that, we must know as much as possible about our tax expenditure. As said, it is a legal requirement in Italy, and I think this is very important because if it was not compulsory to be compiled every year, then what actually would happen that we would find a tax expenditure report for 1 year, and then another year we would not have, and then then again we would have a report, which is not exactly what we researchers would like to have, and what is best also for accountability, right? So in order to avoid discretionality and also to improve the report and to have a consistency of the data, then the best is to have it compulsory to be compiled every year. Another important element of any tax expenditure report is the benchmark. As you mentioned before me, over and over again, the tax expenditure definition is essentially related with the benchmark definition, as it's essentially almost anything that deviates from the benchmark. So what the committee decided to do in Italy is to use the legal benchmark. The reason for that is, of course, is that the legal benchmark was seen as the best option because the economic benchmark might have been a bit too, might have not given a unique result in a sense. So what they decided to do is to use the legal benchmark, so the current tax law benchmark. So what they did for the first tax expenditure report in 2016, and what they do every year for any new tax expenditure, is essentially to analyze a specific tax expenditure. Then they assess if it deviates from the benchmark. So essentially what they do is to ask themselves, does the specific measure deviates from the normal nature of the tax system? Which of course is a very difficult task to ask, because what is the normal nature of the tax system? And as much as possible, they provide some practical guidelines, some rule of thumb in a sense. So for example, if the number of beneficiaries is high and broad, then it should not be considered a tax expenditure. Or if the tax has been decided to be progressive, so for example, let's take a personal income tax. If we design it to be progressive, then it doesn't make sense to consider the progressive tax rate as a tax expenditure. So in a sense, the idea is this one, and this is the benchmark that was decided in Italy. Then a third important element of the tax expenditure or any tax expenditure report is the estimation. As you mentioned before, as also Salvador mentioned before, here's a matter of data availability. And when we talk about data availability, what we do is we estimate the revenue foregone for each of the tax expenditure as much as possible according to the ex post data that we have, in case, for example, the tax expenditure has been there for a long time, or the ex ante data. By ex ante data, we mean that we use any available information that we have, and then we use our micro-simulation model that are based on tax return. Whenever it is possible then to understand the revenue foregone using tax return information, then we use our models and we provide some estimation of the revenue foregone of the year beyond. However, it's not always possible to use tax return data in a sense that there are some tax expenditure that might not be, for which we do not find information in tax return. It may happen. And in that case, we use any other reliable source of information, such as we use publication, national statistics, statistics provided by Trustworthy Institute, and so on. So the idea here is to try, we are very aware that the quality of a tax expenditure report is also to provide a good estimation of the tax expenditure. And in order to do so, we try everything that we can, of course, by using all trustworthy data and the best that we can in terms of micro-simulation model to provide the revenue foregone estimation. So here in the bold, just to give you an idea, here in bold, you can find the percentage of tax expenditure that has been estimated within our tax expenditure in Italy. As you can see, from 2016, when everything started in a sense, where we would estimate around 58% of the tax expenditure, in 2020, we have 70.3% of tax expenditure being estimated. And so here the effort is to continue to rise this trend, to try to estimate as much as possible at the best of our knowledge, of course, and so that we have the best as possible estimation for as much as possible tax expenditure. as many as possible. So as Agustin said, we have some additional information, and those are not, I would say they are very important as much as the estimation part. Why is that? Because essentially they provide us information like very quick, in a very quick way, about what is, for example, the type of tax pay. So what the tax expenditure are related more, so PAT, CAT, VAT, and so on, or the type of tax relief. Should we use more tax credit, tax deduction? What is the budgetary mission? So why those tax, what is the goal of those tax credit, of those tax expenditures? Is a matter of education, of health, and the beneficiary, who are they? Are physical person, are they firms, and so on. So just for the sake of time, I can give a very, very striking graph plot, I would say, about our tax expenditure report. Here in this plot, you can see the cost of the tax expenditure from 2021 to 2023, the total cost in million of euro, which is the red bar. And you see the number of tax expenditure, which is the black rhomboid, classified by the type of the tax base. As you can clearly see, both in terms of cost and in terms of number of tax expenditure, personal income tax expenditure are the most important. And here I think that having this information within the tax expenditure report is very important, also for the research, for reforming a tax expenditure system, in a sense, because this, looking at this, is quite straightforward. That whenever we are looking at reforming tax expenditure, we should keep in mind that personal income tax is a big part of it, and we should keep in mind this importance of personal income tax related tax expenditure. I think it's quite important. It's almost 60% of the total cost is related, of total revenue foregone of tax expenditures related with personal income tax. And here you can find the distribution by type of tax relief. Again, here tax credit seems to be the most preferred type of tax reliefs in terms of cost, while in terms of numerosity, you can see exclusion and exemption are the ones that are mostly used. But then I think it's also useful to just give some example. So here you can find some of the most expensive tax expenditure related with the PAT. So we said that PAT is one of the tax expenditure related with the PAT are among the most costly. And here you have four tax expenditure that are most costly within the personal income tax. Here the data here is coming from the tax expenditure report of 2020. And the tax credit, what you find is that the tax credit for requalification of building heritage is the most expensive one, is among the most expensive one, with 19% of the total cost of the tax expenditure related with the PAT. And but we also have the tax credit for increasing energy efficiency of buildings, which is around 8%. Similarly, of the amount is about, we find a tax credit for health expenses that have been mentioned before, which is about 10 billion euro in a time span of 3 years. So it's around 8% of the total cost. And the tax credit for passive interest on mortgage for the main residence, which is about 2%, so a bit less, but. So this was just to give an idea of how it looks like, and what we have been involved in the estimation, of course, but at the same time, there is a committee that is actually compiling it every year with the support of all these stakeholders, in a sense, all these parts of the professor, the ministry that is providing the estimation, and so on. And then, of course, what we do within the ministry is also to provide some ex post analysis. For example, just recently we published an ex post analysis on the effectiveness of the hyper depreciation, which is one of the tax expenditure for corporates, in a sense, for investing in a digitalized asset. But we have also some ex post analysis on the tax credit on liquefaction of building heritage, and so on. So the idea is that this is from the beginning to the end. So from the committee that is compiling this to the end, which is us having the ex post analysis. This is the whole structure of the tax expenditure report. Thank you.
Thanks a lot, Barbara. Very interesting to see how the whole process go, in a specific country. And in that context, the reform of the personal income tax system in Italy has been a hot topic for a while and has been gaining momentum recently with incoming government. And tax expenditures are at the core of that discussion, right? Some even call for the introduction of a flat tax, right? Just by getting rid of tax expenditures at all. So what is your view regarding the main potential and challenges around the reform of personal income tax-related tax expenditures? So maybe you can provide a few examples of specific provisions where you see potential for reforming in terms of cost, but also distributive impact. Yeah.
Yes. Yes, indeed. The tax reform has been it's been always important, but especially now. And we have been, it has been talking, there will be a lot of talking about the reform of the tax system as a whole and the personal income tax specifically. In terms of, so I would like first to give you some example of some specific tax expenditure that since we have talked about the redistribution impact, which is something that we should look whenever we want to reform tax expenditure, right? We should look at the redistribution of this tax expenditure. As it was rightly guessed during our talk, some of them are indeed regressive. For example, just to give you some quick numbers, the tax credit for requalification of building heritage, the 75% of the cost of the measure is used by beneficiary earning less than 55,000 euro, which implies then 25% of the cost is going to the people earning more than 55,000 euro. And 2/3 of the taxpayer earning more than 75,000 euros actually using the credit, while this percentage much lower is 25% if we look at those people earning between 15 and 26,000 euro. So for some tax expenditure, so when we look at the tax expenditure and we look at the redistributive impact, then we find that for some we have a regressive effect. At the same time, I must tell the truth. Some of them are not so much regressive. As it was mentioned before, tax credit for health expenses is actually quite, we would say, I would not say progressive, but I would not define it as regressive, because almost 90% of the cost of the measure is actually going to the beneficiary earning less than 55,000 euro. So here it's a lot of the matter of a specific tax expenditure, but then when we want to reform it, this is indeed a difficult task. And I would like to cite our new Prime Minister Mario Draghi, that recently actually had a speech about this on the Senate, and he said it's not a good idea to change tax one by one, but rather a comprehensive reform. It makes more difficult for specific pressure group to push the government to take measure to benefit them. So here, when we want to reform tax expenditure, I think reforming the old system and reforming tax expenditure should go hand by hand, because tax expenditure are part of the old tax system. And when we're talking about regressive impact on each tax expenditure, then we must think, okay, but maybe the aim of that specific tax expenditure was not to be progressive. Maybe it's okay that some of them are regressive, but if then the tax system as a whole is able to deliver a progressive tax system, because the tax expenditure the goal of many tax expenditure is different. So they want to incentivize a specific sector, they want to incentivize some specific behavior, environmental friendly behavior, or they want to face some market failures, of course. And so I do think that while we might have some regressive tax expenditure, also as you mentioned before, tax deduction are among the most regressive ones. So we have, for example, the tax deduction for pension scheme, supplementary pension scheme contribution, which we find is actually among the most regressive one, as 68% of the cost is going toward those earning less than 55,000 euros. So we have much more going to the one that earning more. So what I would say, so to conclude, what I would say is the following: that in order to reform the tax expenditure, it's important to reform the system as a whole, to have a comprehensive view. Of course, it's not we should not have a lot of small tax expenditure that without knowing what they are doing, what their costs. We should we are and we should doing more and more analyze them, but at the same time having a more comprehensive reform that's thoughtfully thought. Thank you.
Thanks a lot, Barbara. And just a brief comment on what you just said. I totally agree that not all tax measures need to be progressive, but for me, it's unacceptable is the lack of transparency that often exists. And it all ends up being a political decision. So if a government tells me, I still want to introduce this particular tax expenditure, even when it has been proven to be ineffective or regressive, that's fine with me. But that piece of information, I think, as civil society, at least, we should push to get, right? That's for me the primary. Then it comes to a political decision, and that's another discussion. We can agree or not, but yeah.
I absolutely agree. I think having a good tax expenditure report is an important piece of the puzzle. Yes, I agree.
Exactly. Thanks a lot. So let's now move to the wealth taxation, which, as I said before, there are a lot of interactions with personal income taxes also through the taxway. So it's a very interesting topic. So wealth taxes indeed have been gaining momentum in recent time. We all have followed the political debate in the US primaries with a proposal by Senator Warren that's about an annual wealth tax, in a sense, or wealth tax, permanent wealth tax. But also in the context of the COVID-19 pandemic, some countries have already introduced, like Argentina, a one-off wealth tax, and some others are considering doing so, right? So Arun, you're part of the Wealth Tax Commission that studied recently whether a wealth tax is desirable and deliverable in the UK. So could you please give us an overview of the work and main conclusions of the Commission? I would particularly be interested in the strong position of the Commission calling for a broad tax base. So if you can develop on that one, please. Thanks.
Yeah, great. Thanks, Agustin. So let me set out a bit. So as Agustin said, I'm one of the commissioners at the UK Wealth Tax Commission, along with Andy Summers, who's an academic lawyer, and Emma Chamberlain, who's a barrister. I'm an economist by background. So I'll tell you a little bit about the commission and what we did and what we concluded, and then we'll talk in some detail about the views specifically on what the base should be. So the commission was set up to think about the issue of whether a wealth tax would help at this point in time. There were a few newspaper articles in the UK talking about the idea that a wealth tax might be the solution to paying for the pandemic back in April last year, sort of long before we even knew what the true cost would be, when people thought, oh, this will all be over by summer, but it might cost a bit of money. And of course, now we sit here a year later and we're still, none of us outside of the pandemic yet. And we were basically set up to think about whether a wealth tax could be the answer, because certainly in the UK, there hadn't been any sort of serious study of the practicalities of a wealth tax for about 45 years. And so looking at these sort of things from the mid-70s and thinking, well, is this really the basis on which a government is going to make a decision about a wealth tax? We felt this was really not a kind of firm evidence base from which to start. And so we set up the Wealth Tax Commission to study this question of whether a wealth tax would be desirable, deliverable. And the kind of key conclusions we came to were, firstly, that a one-off wealth tax would both be deliverable, in the sense that you could certainly make it happen, and desirable in the sense that if a government is deciding to raise taxes at the moment, we think that a one-off wealth tax would be better than alternative options. So we're not taking a stand on the question of whether taxes need to rise now. That's sort of a macro question. I think there's some disagreement about this. I have my personal views on it, but in the UK certainly, and in many other countries, there are discussions. And also, firstly, anyway, that question varies by country, but certainly within the UK, the government and the Chancellor has taken a strong view that he wants to raise taxes in the coming years, sort of pay off the debt. And so, having come to the conclusion that that's what he wants to do, the question is how should he raise taxes? And we think that a one-off wealth tax would be a good part of a solution. I should say at this point, given this is a discussion overall about tax expenditures, there are lots of problems, and we may come to later, in the current tax system in the UK. And we sort of, the second part of our recommendation was very strongly that we deal with those. We go and tackle those issues. We realise that we can talk in some detail about what they all are, but we recognise that there's a sort of longer term agenda in thinking at that, in designing well what the alternatives should look like, and that if there's a sort of pressure for short term money, in many cases some of those reforms will pay off, but some of them won't pay off immediately. So at least one example I should just give you quickly is capital gains tax, if it were to be reformed, would raise revenue, but you might expect that if you were to raise the rate of capital gains tax, which ought to happen, that would postpone the point at which people, there'll be some realizations before the rate goes up, and then you might see people postponing for a little while the point at which they are doing further gains. So you may not see that much tax revenue coming from it for a little while before the money comes back in again later. So if the concern is short-term cash, it may not be that all of these adjustments to existing reliefs and tax expenditures would be the best way to get that. So we think a one-off wealth tax is important there. In terms of an annual wealth tax, we recommended that an annual wealth tax isn't considered immediately as a solution to sort of the existing problems. The kind of key distinction, so the obvious distinction between the two is that a one-off is one-off, and an annual wealth tax, you have to revalue assets every year. So a one-off wealth tax, you might have people pay the money over a few years, but the valuation is done all at one point in time. That point in time is essentially the morning before the Chancellor makes their, the Finance Minister makes their announcement, and so there's no kind of real scope for avoidance behaviours, and that's good in terms of efficiency. It's also kind of administratively much easier because you're only having to get the value at one point in time, whereas an annual wealth tax, you need to annually revalue things, and certainly countries have ways of implementing annual wealth taxes, but they largely do so, where countries have annual wealth taxes, they largely do so by departing from the kind of concept of open market value as the basis for valuing assets. And that's sort of problematic. You see that what that causes is a lot of friction over how do you value things, for example, private businesses. And that is, for example, what led to the German wealth tax being declared unconstitutional. It wasn't that a wealth tax per se is unconstitutional. It's that the practical way in which it was being implemented was seen as unconstitutional because it wasn't really treating wealth like for like between different asset classes. And so that's really important. So as Agustin said, we were very clear that we think that all asset classes should be included in a wealth tax. So that means housing, including primary residences. That means pensions. That means businesses. That means obviously financial savings and financial assets, whether that's savings in a bank or ownership of bonds or equities at arm's length. We think all of those things should be included. We also think personal assets should be included, with the one proviso that we don't think it makes particular sense to try and value every paperclip and every pencil that people own. And so we set a sort of de minimis threshold of £3,000, which will basically rule out most of the assets that people own, sort of small assets people own. So it would keep in things like housing, obviously. But so the main other things it would include are cars. It would end up including some sort of specialist things that people might have if they have particular kinds of expensive musical equipment or expensive paintings or something. But it would rule out kind of lots of the sort of day-to-day assets that people have that would just become quite administratively cumbersome for them to have to value, and for HMRC, for the tax authority to have to go and sort of check, given there's not really much revenue there and it's not really an effective way to avoid, given these are basically wasting assets. It doesn't seem like a problem for avoidance purposes. So why did we conclude that all asset classes should be included? There are basically 4 reasons. So the first is just a very practical one in terms of getting money. Taking out any of these asset classes costs a lot of money. And that's particularly true because if you think of the structure of a wealth tax, the structure of the wealth tax is define the asset base. So suppose we've said it's everything. So for me, out of the value of all the stuff I have, take off any debt I have, the value of my wealth above some threshold is what I'm going to pay tax on. So taking away any asset class can bring me quite close to that threshold or below that threshold. And so even if any individual asset class isn't the majority of my wealth, it can completely wipe out my liability because it can bring me down to that threshold or below that threshold. And so we find that, excluding basically any of the asset classes, so the 3 biggest asset classes are houses, pensions, and then businesses. And excluding any of them quite quickly drops out almost half the revenue that you get from any single asset class because it's just taking so many people close to or below the threshold. So it's really a problem to do that. So on a revenue standpoint, it's a bad idea. The second reason it's a bad idea is for horizontal equity. There's a horizontal equity problem in not taxing me on the house that I own, but taxing someone else who's saving to buy a house but hasn't quite got around to it yet. They're in the market, they're looking for it, they have all their money in the bank account, and then you're going to go and tax them. That doesn't seem very reasonable that they ought to be taxed. Or someone who chooses to own a smaller home and have more other kinds of assets. They're being taxed more heavily than someone who chose to put more of their money in a home. So we think that's not really reasonable. Similarly, we had a lot of debate about pensions and businesses, because obviously there are lots of people who strongly asked us we were going to exempt one or other of those classes. And clearly the business owners would be very annoyed if pensions are exempted, because for them, their business is their pension. Lots of small business owners are thinking about not saving separately in a pension. They kind of keep their money within their business. And the idea is at some point when they retire, they'll sell off their business, and that is their pension. So taxing other people's pensions, not taxing other people's pensions, but taxing effectively their pension is horizontally inequitable. Conversely, sort of excluding the business, will create inequities in the reverse direction. Should I invest in a business or should I keep stuff in pensions? We don't really want that kind of horizontal equity problem. There's also a vertical equity problem, and that's particularly obvious with businesses. Business ownership is particularly concentrated at the top of the wealth distribution, and so excluding businesses creates not just a kind of comparison kind of across individuals with similar levels of wealth. It also creates the problem that it means that people who have relatively high levels of wealth, because their wealth is often concentrated in businesses, will pay much lower rates of wealth tax. And finally, avoidance is clearly an important issue. It's one of the things that is always touched on whenever we think about these sorts of reliefs and tax expenditures. Is you might have one purpose that you had in mind for designing these things, and that's usually where policymakers start, is they have some brilliant idea of what they want to support or exempt, and they do that, and they don't always take into account the fact that while it exists for this purpose, it will be used by lots of people who don't have that purpose in mind, but find this a kind of convenient way to reduce their tax liability. And so that's a really important part of what we tend to see, as we all know, in terms of the response to these kind of reliefs. And so we were very strong that that's another reason why we wouldn't want to exclude any of the asset classes.
Okay, thanks a lot, Arun. Very interesting. And clearly the tax rate is crucial when it comes to the design of wealth tax. And as you said, the proposal of the Commission is clear-cut to make it as broad as possible, including all type of assets. Yet the progressivity of the wealth tax depends on how high the exemption threshold that you mentioned is, and whether a graduated rate schedule is applied among taxpayers, right? And on that note, the Commission did not take a position or concrete position. You did provide some simulations. So can you develop a bit on that one? Why that was not the case?
Yeah, so I totally agree that the progressivity of it will depend entirely, essentially, on where you set the threshold and then how you design the rate schedule. We basically see ourselves in this, at least in the UK, being an expert has become a dirty word. There was a political. There was a politician a couple of years ago who said we're tired of experts. I don't know if that became something that got outside the UK, but in the UK, they sort of refrain that we're tired of experts. We've had enough of experts. Has become a real kind of political battleground with different views of whether we should think of experts as being relevant or important in any way. But for what it's worth, we saw ourselves here as sort of technocrats and experts who are here to help sort of design taxes and think about what's the space of possibilities, what are the things that are possible, and how could they be designed, what is better or worse from a technical standpoint. And then we think there's basically legitimate political debate to be had about how many people should be covered, how much, what should the rates get threshold, what should the average rate be in terms of how much revenue do you get in total, and how should that be distributed? So what should the progressivity of that rate schedule look like? We think there are some technical bounds on that. So we said, don't go below certain rates because you will just not really get any money compared to the administrative cost. We gave some ideas of how high you could go before the liquidity problems would really mean that in practice, either you wouldn't get money for a long, you wouldn't be getting the money because the money would just basically be deferred for a long time, or you'd be requiring serious amounts of sales of assets, not just the odd thing, but really having a large impact on the economy. We also talked about where the thresholds would be below which you kind of couldn't do it, because again, you'd bring in a lot of people who would pay not very much, but would have high admin costs. But beyond that, we really think this is a kind of political question, and we don't have any specific kind of expertise in in the answer to that question. It's really a social question for the public to decide. And so we designed a tax simulator. You can get it on our website, where you can go and design your own wealth tax. You can see how much people would pay. You can share the tax design that you've made. But apart from the fact that the three commissioners didn't agree on what our own individual political preferences would be, so it would make it hard to write down any conclusion. We also don't think it's really our position to tell anyone what that ought to be. And so that's why we both tried. I mean, we sort of started off by trying our best to incorporate in some tables and figures what that looks like, and in the end decided the only sensible thing to do was to produce a simulator so that people could design their own tax and see what the ranges are, because we could never give all of the possible examples that people might want to see, and then someone would say, well, you showed us what it looks like at this rate but not that rate, what would that have been? So now it's completely open, everyone can access it, everyone can edit it and fiddle with it and see what they would get. So it's completely transparent in that sense. I think we spend a lot of time, all three of us as commissioners have spent a lot of time advocating that governments be more transparent in how they do these things and what they do. We felt like we should live up to our own standards. So we have a whole paper explaining precisely how every calculation is done for the simulator, and then we have a simulator so people can see it all themselves.
Okay, great, fair enough. Thanks a lot. So yeah, before I come back to the personal income tax, let me invite Arun Advani, who's senior tax with the Federal Tax Administration in Switzerland. And I think it's interesting to have his view, because often wealth tax opponents argue that they are just ineffective because people would move assets abroad or even emigrate, right? And Switzerland is maybe one of the most successful cases in terms of wealth taxes, even so in terms of the revenue, the revenue collected through the wealth tax. So maybe, Arun, you can give us a bit of a brief overview of the wealth tax in Switzerland.
Yeah, well, let me just start off by saying that the wealth tax in Switzerland is only levied on the cantonal level. So there are major differences depending on where you live. But it has been said that Switzerland is the world champ in terms of wealth tax, which sounds odd when you think about it. But it must be seen in the light of the total tax system. For instance, on a personal level, if it's not when carrying out a business, there's no capital gains tax. So in a way, the wealth tax compensates for the absence of a capital gains tax. We also have a very fairly low inheritance tax. We had a popular vote on a federal inheritance tax just a few years ago, which did not succeed, surprisingly. People still think they may have an uncle or so somewhere that might leave them significant wealth. And as I heard our colleague from UK mention, property valuation is typically fairly low. There are legal limits. However, to revalue these properties regularly involves some cost, and it's politically attractive to postpone that when possible. And then occasionally the canton has to catch up with revaluing properties, which then leads to higher revenues. But it's understandable this is not a very popular thing to do. Yeah, I think that's the main thing as far as the wealth tax is concerned. So no federal wealth tax, but the cantonal one compensates for the absence mostly of the capital gains tax. And there are some other benefits thrown in that in all, it's not unduly expensive for taxpayers.
Thanks a lot, Arun.
Sure.
Thank you. So also, we know that, and now I'm moving a bit into the political economy, right, behind tax expenditures in a sense. So European institutions have direct influence over member states when it comes to VAT tax expenditures. There's even a regulation of the tax base in that sense. A bit of a less direct influence when it comes to corporate income taxes through, for instance, the Code of Conduct on Harmful Tax Practices, But when it comes to personal income taxes, the influence is much weaker, right? If anything. And you mentioned that the European Parliament has called EU member states to phase in full individual taxation, including the elimination of tax expenditures and benefits based on joint income. But you also mentioned that there has not been any action on that note, besides a few exemptions countries. So which are, in your opinion, the EU mechanisms that could potentially contribute to the reform of tax expenditure systems when it comes to personal income taxation?
I mean, the European Parliament, they just do resolutions, and they don't, that is binding for the European institutions, but it's also only a recommendation for the member states. So it's true, personal income tax is not an issue formally it's not an issue for the European Union, even though we have a quite active European Court of Justice that has a kind of in the lack of political decisions, we have in the lack of political decisions, we have they kind of make a quite fundamentalistic interpretation or very close interpretation of the treaties and promote some parts of the personal income taxation. But no, we don't have any mechanism for there is a possibility, and it's done in the European semester. That is a soft law instrument with country reporting, and there they are. They have raised the question about joint taxation in Germany, and kind of try to correct Germany that practice joint taxation. But I mean, Germany regard joint taxation as a constitutional right, and they base their whole housewife system and breadwinner system on joint taxation. So to a large cost, of course, but still, that's no, there's very little and I also said there is a lack of legal mechanism to really harmonize, and you can see about happening with the corporate tax base. It was very early, at a very early stage in the European Union. They pointed out that to have free mobility over borders, we need to harmonize the VAT, which hasn't happened, but still we have at least moved the control of the VATs inside the countries instead of at the borders. So it seems like we have harmonized it, but it's really complex system now with European tax collection. But the second one was how to harmonize the corporate tax base. And now we haven't done that, and it has been, they have, during our fair tax project, when we started the consolidated corporate tax base issue was quite dead, but they brought it up again on the European Commission level, and it became a very high priority because, of course, we have a tax competition situation in Europe, and we also, among the member states, have kind of tax haven and secrecy jurisdictions that makes that kind of drifting the European apart in much a bigger way than the Commission wants to really recognize. So that's why it's on the table again, but yeah, it's very complex. And I want to add, when we talk about tax expenditures and all those kind of deviations, that some of those deviations are completely accepted by a strong voice in the society. And others are never accepted because the voices are too weak. So it is a power over the narrative, the tax policy narrative, which the crisis help us to kind of open up for. It helps up for new perspective, because I think the Commission is really now in a panic, and that goes also for the United Nations and the OECD and the IMF and the World Bank. They try to fix something that they originally have unmanaged to fix before, or maybe they even haven't wanted. They have wanted increasing inequalities to have a competitive economic environment. And that goes for the European Union, and it goes for the World Bank and so on. But now they are trapped in the demand on a sustainability regarding the fiscal revenue. It's not a theoretical issue anymore. It's a hand-on issue.
Yeah,
sure.
clearly. Yeah. And what I find even more striking, even when the institutions are there, like the directive that I mentioned before on the obligation to report on tax expenditures, sometimes even then countries just decide to breach those institutions, right? So Salvador, on a similar note, you mentioned that the Joint Research Center works, or the aim, the goal is to provide a service or advice to policy services in Brussels. So how do you measure the impact of your work, assessing, for instance, the fiscal cost, effectiveness, and distributed impact of tax expenditures? Do you have concrete examples of policy impact of this work in member states? And I know it's a tricky question. It's the million-dollar question on how to track policy impact also for us as a think tank. But yeah, I would like to see how you do that, if any. You are still muted.
Yeah, sorry. I think, thanks. It's a tricky question, which is asked to us on an annual basis. We have a policy impact assessment report, which is done every year, because our role is clearly to focus and to provide policy support. Now, I mean, having a policy impact for us, the question, I mean, for us, it's maybe more natural, but in general, we are a research center, we are a research institution in the end. We are within the Commission, but in the end, what we do is to carry out research on very specific policy issues, right? So your question maybe is maybe too specific. I think the broad question on whether research or scholars have an impact on the policy debate, the answer is clearly yes. Whether this impact can be measured, well, I made the joke starting this intervention. In our case, we have to measure this impact, and our impact goes through a number of documents in the Commission, right, published by the Commission. So we are present indirectly in the country report that provides support to the country-specific recommendation. We contribute to a number of policy reports by the Commission. I mean, we are quite present in Commission publication and recommendation dealing with tax and social policy issues in general. Now, the one key aspect is that taxation remains a prerogative of the member state. Okay, so, and that's clearly in the treaty. So you have taxation intervention at the EU level, essentially on two grounds: the distortion of the internal market. So whenever tax structure are deemed to distort the good functioning of the internal market, then you can have a justification for EU level intervention, provided that you respect the principle of value added and subsidiarity. So you have to intervene where it is the most efficient. And then in the area of state aid rules, right? So when you have a distortion of competition via a specific tax advantage. So these are the tools essentially for a policy, direct policy impact. Now the policy through the European semester, policy recommendation, whether they are effective or not, I don't know of any study. I mean, I would be interested to see that. That's interesting. That's something which is done for the indirectly for the Stability and Growth Pact, for instance, no? To know whether the Stability and Growth Pact has an impact on the debt and deficit in the EU. That has been analyzed. We have analyzed those things ourselves. But in terms of the impact of policy recommendation, given that the Commission has no specific prerogative outside the one I mentioned in this area, it's difficult. Now, whether there is an impact and whether the recommendation have an impact, that's, I think we all agree with that. I mean, knowing the EU debate, knowing the recent evolution with the financial crisis. I mean, the semester was set up because of the financial crisis. There was the willingness in particular for the Commission opinion to be heard and taken into account in drafting budget in autumn. I mean, all those things suggest that there is an influence. Whether this influence is tangible, measurable, it's subject to interpretation. But I mean, I think we can all agree that there is a growing interaction and role play by the Commission in this area. That's for sure. Concerning us, we are a bit in between. We are a research institution, but we provide policy support, and we are very close to the policy making, at least at EU level. We work on all the main tax policy issue in the EU, so we follow closely the discussion and we provide support with our analysis. But again, I think more generally, the influence of scholars, of researchers in the area of taxation has grown clearly over the past. I mean, all the discussion on inequality and tax evasion by multinationals, for instance, just these two aspects has gained prominence, I think, largely thanks to the work of a researcher and academic in this area.
Yeah, totally.
Which is
very often you fill in the gap that when it comes to evaluation, right? Empirical cost-benefit analysis, type of empirical evaluations, that is not for many reasons done by government, it's done by research institutions like yours. So clearly, thanks, Salvador. Barbara, very quickly, so what I hear often by policymakers as an excuse not to, move farther when it comes to tax expenditure estimation and evaluation and reporting is this lack of data argument, which I personally find a bit striking because I think governments sit on data, actually, right? The tax return filings are collected by government. So in my opinion, if any, what is missing is a political will or resources to exploit the data. So can you, and in your, as I said, even if the Italian report is one of the best ones, you still have 151 tax expenditure provisions that are impossible to be estimated, right? So can you give a bit of a concrete, hands-on view on this impossibility? What exactly is behind this lack of data, impossibility to estimate particular revenue foregone estimates for certain provisions?
Yes. Also, this is a quite tricky question, but yes. So I would start saying that I think the past year, I mean, I can talk only, of course, at the Italian government, what I see, right? I think the past years we've been doing great advancement on this, in a sense, because the issue is that, as you said, data are there. I mean, data on tax return are there. Of course, you have to think that we have a time lag, so which is necessary because tax return data are available only after 1.5 years, and for firms you can go also for 3 years. And then if you want to connect also budget information such as Orbis dataset, you have to wait for the Orbis dataset to be available for the year. But so I think that one thing is the time lag that we should not forget, because even though the taxpayer finished to compile the tax return, then we must wait for the end of the year. We must wait for all the data to be cleaned and to arrive to ourselves. Once this is done, I do believe there is now more than ever, I think, an attention to this topic. I mean, just to give an example, as you before mentioned about ex post analysis and evaluation. So we've been doing much more about that. So, for example, we have a working paper series that we have been. I mean, now many of us as PhD. in economics, and so we have been providing some our technical workforce, in a sense, so our technical knowledge to provide as much as possible the best ex post analysis using the data available. And for example, as I was mentioning before, we recently published a paper on the effect of the hyperdepreciation that was being introduced in Italy. And we published it, I think, 6 months ago or something like that. And before that, there has been also the impact on the tax, the tax evasion on tax evasion on a specific measure and so on. We have been working on building a new CGE model. I mean, I think a lot have been doing. Still, a lot of has to be done yet, right? I think that there is, as always, a matter when talking about government. It's always a matter of also resources. I mean, we are doing as much as possible with resources that we have. I think that it's good to see a trend, a tendency, and I think in this we are, I can say, pretty good. So coming, after the PhD, entering into the government and seeing still doing research is very strong. Research is very good to see, right? It's not just a government that does nothing. But in the end, when you're right to ask for analysis, I think it's a right of the taxpayer to ask for more transparency, and I think it's good and it's the right direction to continue to provide ex post estimation. I think it's a good direction, and hopefully we are improving much more, having different data sets. For example, it's going to be forthcoming a data set on BEPS, on profit shifting that we've been working on with new data of a country by country reporting. So new data are available, and the sources, the software that we are available are different than one that 10 years ago our colleagues had, of course. And I think everything is going to the right direction, I would say, regarding our Department of Finance. So we have much more importance on that. Of course, we have still things to do, but I think the direction is that.
There's certainly a learning curve, right? As you mentioned before, these countries that engage on a one-off thing usually doesn't pay off. The beauty of it is that this is a learning curve, and countries can improve their tax expenditure reporting. So totally agree. Thanks a lot. So there's a question from the public, Ian Campbell, for Arun. So maybe, Ian, you want to actually kick in and ask that question very, very briefly, because we are getting to the end. So Ian, if you want to ask your question directly to Arun, that would be nice.
Hi, Arun. For everybody's benefit, Arun has just sent me a fairly long and detailed explanation in a side chat. So okay. I think the issue was really whether or not. Yeah.
I thought we were out of time, so I sent it quickly.
If you want to share a summary of the question and a summary of the answer, that would be great.
The question was, can you treat private pensions in the same way state pensions, given this issue about contractual obligations, convertibility, and the rest of it? And I think that you can't ignore the state pension, and Arun's coming up with reasons why, for his purposes, you can.
Yeah, so my view is that we, so the view of the Commission, when I said we include all assets that people own, so we treated wealth as the value of all private assets that you own, less the value of all debt. Whereby private assets, we mean all assets that you have a contractual right to own. So that includes your private pension. It does not include a state pension. And so Ian's question was, should we include state pensions? And I think there are various reasons why we don't. I mean, as a kind of legal matter, it is the case that my rights to a state pension is not a private asset. It's not a thing I can enforce a contract on the government to make sure they give me that money. The government, for example, in the UK currently has, or policy in the UK currently states that the value of the pension amount that's paid in pensions will increase by either the rate at which wages increase or inflation, or 2.5%, so that you have this kind of triple lock that means pensions basically always ratcheted up. It seems unlikely that's going to survive until the point that I reach my pension age, and it's not even clear that my pension age will be the same as it currently is, given that I'm still in my early 30s. And I would be surprised if in 30-something years' time I'd still be allowed to retire in my mid 60s. So it would seem inappropriate, given that I don't have a private right, to ensure that I get a pension at the date that it's currently scheduled with the increase that's currently programmed in, because that could just change, and governments have changed those things in the past and are likely to change them in the future. It seems inappropriate to value my pension taking into account all of those things. So that's why it's one of the sets of reasons why we think it would be inappropriate to include those. Just to say also, once you do include them, if for people who would like to include them, if you were going to include the value of sort of state things that you get access to, you'd also be wanting to include the value of the insurance you get from state unemployment benefits, the insurance you get from the state healthcare system, and so on. So there are a whole set of things that we all have entitlements to that aren't private law entitlements. So it does get a bit complicated at that point anyway.
Okay, right. Thanks a lot. Thanks for being brief. We hope to see some of the recommendations at least implemented in the UK soon. So thank you very much, the four of you, but also the rest of the audience. It was great. I think it was a very productive and constructive debate. We will have a few more of these roundtables with a focus on the US and on domestic revenue mobilization, always trying to see the role of tax expenditures in those debates. So you will certainly hear from us. Thanks a lot and have a nice day. Bye-bye. Cheers. Thanks.
Thank you. Thanks a lot. Pleasure.
Thank you.
Bye-bye.
Bye.